start off with our materiality. So you've got your two ones. You've got the handout and you've got the handout up on the board as well. So I'm going to start with this first handout here, the introduction one. Just to go through the basics of it first. So we're looking at materiality, internal controls and audit risk. And the three of them combined together are a big part of what we're looking at in auditing. I'm just going through the basics of it now here first tonight and then do questions after that in the second part. So these concepts are addressed by auditing standards which are included in subsequent units. However, before progressing, it is important to gain a general understanding of the concepts and terminology which we will be frequently using. So materiality is defined in the International Accounting Standards Board in the following terms. Information is material if its omission or misstatement could influence the economic decisions of users taken on the basis of the financial statements. Materiality depends on the size of the item or the error judged in particular circumstances of its omission or misstatement. Thus, materiality provides a threshold or cut-off point rather than a primary qualitative characteristic which information must have if it is to be useful. Okay, and if it is even the structure one up here on the board, information is material if its omission or misstatement could influence the economic decision of users taken on the basis of the financial statements. So you're trying to set a threshold for materiality to see if you find a mistake, is it material to the audit or is it not material to the audit? And they usually give a guidance here. You have a 0.5% to 1% for revenue, 1.5% to 2% for total assets, and your profit before tax, you could have a 5 to 10%, but it's normally more likely than looking at the 5% materiality. So it's best, if you look at an example here, this is best illustrated by example. So if you have €1,000, decision to make a purchase worth 900 would be significant. 900 would be material to you. You consider the purchase very carefully because it would involve spending 90% of your cash and you only have 100 left. Contrast that with a decision to make a purchase worth 900 if you had 10 million. This would involve minimal consideration compared to the previous scenario. It's unlikely that you would notice spending 900 out of 10 million. Okay, so your materiality depends on certain circumstances. So if you had €1,000 decide to spend 900, that's material to you. But if you've got €10 million and you decide to spend 900, that's not going to be material to you. Similarly, 50,000 is material to a small company which generates a profit of 60,000 a year. If there was a misstatement of 50,000 in the financial statements of the company, it would be very significant because they're only making a profit of 60 and you've got a misstatement of 50,000 that's very, very material. It would change the view of the accounts depending on the direction of the misstatement. It could mean that the company made a profit of 10,000 or the company made a profit of 110,000. Okay, the 50 plus the 60, if it should be 50,000 included more, or the 60 minus the 50 bring you down to the 10. In this case, 50,000 would influence the economic decision of the user of the financial statements as per the International Accounting Standards Board definition above. Is that alright, yeah? Yeah? Contrast this to a misstatement of 50,000 and the company with profits of 10 million. Depending on the direction of the misstatement, it could mean that the company made a profit of 9.95 million or the company made a profit of 10.05 million. In this case, 50,000 is not material to the company. It would not influence the economic decisions of the users of the financial statements. Okay, so that's just the basis of what materiality is. But if you look up here as well, there's actually more, you actually have them on your notes there as well. It's just done a little synopsis size here. So the omissions or misstatements of items are material if they could, if they could individually or collectively influence the economic decisions of users taken on the basis of the financial statements. The size of the nature of the item or a combination of both could be a determining factor. And if you can remember the definition and maybe give the little examples there, do you know what I mean, showing how 50,000 affects a small company if they got a profit of 60, but a company making a 10 million profit at 50,000 won't affect them at all. And this gives a little, on the next page there, it just gives a little chart. Okay, so the nature and timing and the extent of procedures Where do you seek adjustments, and the degree of AR modification? That's audit risk, if you're right there. And we're going through what audit risk is there now in a minute. Okay, so you're looking at the impact on your audit. So we're thinking about our audit here all the time. What impact materiality is going to have on our audit. So the higher the materiality percentage we set, it means the more work the auditor is going to have to do. It's more things they're going to have to look for inside the audit. The concept of materiality effect on judgments and decisions of users. The auditor considers materiality when determining the nature, timing and extent of audit procedures. So what kind of testing and stuff it's going to do. Evaluating the effect of misstatements on the fair presentation of financial statements. So it's all like the same materiality we're looking at and the effect on our audit. So you always think of materiality and the impact it's going to have on our audit. That's what we're thinking about all the time. Okay, quantitative decisions. If you go to the next one there down. Okay, threshold. An amount equal to or greater than 10% of operating profit is regarded as material. An amount equal to or less than 5% of operating profit is regarded as immaterial. So if you're looking at, say, debtors at the end of the year, okay, and you're testing your debtors to make sure all your debtors have been included inside in your audit, and discover that they left out 20,000 worth of debtors at the end of the year, you must decide, is that material to the audit or is it not material to the audit? So you have to go back and look at and see what profit they're making or what their turnover is. Like our example, the 50,000 being very, what's the word again? It having a big impact. If you're 50,000, you've got 60,000 profit, but if you're 50,000, you've got a 10 million profit, it's not going to impact on your materiality.
What happens if you repeat that?
Well, you probably do, 10 will be the very most, well, you have to do a lot of work in between 5 and 10 as well. Other bases, equity, appropriate assets or liability class, total revenue, and just we go through. The best way to do this is go through examples, and an example of these over the next couple of weeks, okay, for when we're setting materiality. But tonight, just wanted to get through what materiality actually is. Okay. If you go on to the next one there, so you know we don't actually need. If you go on to the next slide there, number 4 page. To number 4 and the second slide on that page. Materiality at the account balance level. Evidence is gathered at the account balance level to determine whether an individual account may be materially misstated. It's necessary to find some method of allocating financial statements materiality to individual accounts. Okay, so if we go on to the next page. Preliminary judgments about materiality are made at the planning stage for the purpose of determining audit effort. The more material an item is, the more evidence that is needed for its verification. So we're at the very start of our audit and we're doing our planning. We're planning how we're going to do our audit, how many people are going to be in the audit, and you set a materiality percentage. If you've been doing an audit for years, you've no problem because you're probably going to follow the same percentage materiality the whole time. It's when you start to take on a new audit that you have to look through it and see, do you know what I mean, what business they're in, what would be material in that. That's what you look at. You look at all that kind of little bits and pieces. The more knowledge you have about the business, the easier it is actually to set your materiality percentage level. As I said, the more examples we do, the easier this will become. But if you think of materiality at the moment as what the examples are here, okay? Is it material to your accounts and is it going to impact on your audit? Or is it not material to your accounts and it's not going to impact on your audit? And we'll come back to there now again after I've got questions. But just to know that these words are thrown around a lot inside of the auditing questions: materiality, controls, risk, just to get the basic understanding of each of them first. So our next step is controls and internal controls. So I'm back to this handout again now. Okay, and this is the next page. It's page 86 on the top left-hand corner there. So these are internal controls now inside the company we are actually auditing. Okay, so what are controls? Controls are all the means devised by an organisation to promote, direct, restrain and check upon its various activities for the purpose of seeing that the organisation's objectivities are met. So these are actually inside in the company you're actually auditing, and this company is supposed to have put controls in place. And there are two main types of controls: preventative controls and detection controls. So preventative controls, these are built into a system to forestall errors, deliberate misuse of resources, and thereby avoid cost and other implications of correcting them. Some examples are the segregation of duties to prevent intentional wrongdoing, and proper authorisation procedures to prevent improper payments being made. Examples include segregation of duties and authorisation. So like you usually say, you should have one person who decides what has to be paid, but then another person should actually be issuing the cheque and actually signing off the cheques. So you're segregating out your duties. And the same with the payroll, especially in payroll, they're saying you should have someone, do you know what I mean, doing the accounts, or doing the payroll, and then someone else actually issuing the cheques out. But like in a small business, that's not going to happen. We're thinking now of big, huge businesses here at the moment. Then detection controls. These measure the effectiveness of the preventative controls and help to identify errors and intentional and unintentional misuse of resources when they occur. It is often the case that preventative controls can work 100% effectively, and therefore detection controls are needed to highlight problems. Example, bank reconciliations and physical counts of inventories. So at the end of the year, you have your count, or maybe in a big business you probably have, maybe at the end of a month you might do a count of your inventory. So to illustrate both types of controls in a particular operation, consider a warehouse inventory function. The controls might be as follows. Okay, so we've got a warehouse now and inventory in the warehouse. Your preventative controls may be: inventory items are stored in a warehouse restricted area, warehouse security, inventory issued on the basis of approved general ledger accounts, records kept of good inwards and good outwards. So that should always happen, like in a warehouse situation. You don't have someone giving out the key and saying, oh, go off there and take whatever you need. Do you know what I mean? There should be a system in place there where only maybe one or two people have the key to the warehouse. So you're preventing people just going in and just maybe taking stuff for themselves. Whereas detection controls then, physical inventory counts are performed at periodic levels, periodic reports to management of inventory in hand, and reconciliation of stores records to requisitions. Okay, so you actually would look at what should have come in, you go in and look at the stores and see is all that inventory actually inside there. You have a system in place where you have where someone has to sign out for items. So you go to the warehouse, there's a guy there who's actually giving out the inventory, and he has to sign off on it, and then you sign off that you actually got the stuff as well.
Transfer.
Yeah, that's it. They're all just controls in place to make sure that your inventory is okay. And just remember, you need to know two lots: your preventative controls and then your detection controls. Another illustration is a system of control of cash receipts. Okay, and that's a big one, cash receipts. Do you know what I mean? It's very, to put controls in place for that. So receipts and tickets should be serially numbered. These are preventive controls now. So you're saying every receipt should be in rotation. Okay, and that should always be there, no matter what your business is. Formal policy established for handling of cash receipts. Cash income when not received through a till, acknowledged by issue of a ticket or receipt. And really, all your cash coming in should be acknowledged with a till receipt. Then detection controls, internal audit spot checks, frequent independent reconciliations of cash banked with till rolls. So what we'd have now, we get in all the till rolls from a lot of shops at work, and we'd actually check them off.
The dual till rolls.
Sorry?
The dual till rolls.
The dual till rolls, yeah. And you tick them off. You couldn't go through every whole one now, but you'd spot check and make sure that the right amounts are there and stuff. And then spot checks by ticket inspectors and tickets held by customers. Okay, and like if that kind of question came up now, that'd be exactly what you could do. Say what a preventive control is, say what a detection control is, and give your 2 examples. Give like the warehouse one, what preventive and what detection controls are for that, and the same for your cash receipts, if you can put the controls inside, show the 2 controls in that. It's actually, Joe, it's quite, do you know what I mean? It is common sense stuff really, like, and it's actually what's out there in the real world, but just to...
That's what we do now with the cash.
With the cash, yeah?
Till receipts and stuff.
The till receipts, yeah.
I have to check every morning. I hold on to them for 2 months and then
You didn't bill them after that, yeah? The accountant doesn't hold on to them, no? Because we hold on to all ours, we have files for the shops we have. Just,
they go through.
You probably have them on anyway.
When it all comes up in a printout in the morning, I go through all the till receipts, make sure that everything ends up, adds up to the receipts, the credit card receipts.
Yeah.
I hold them for 2 months, and if there's no issues after that, then they do.
Oh yeah, and then it's all controls. We just don't think about it, do you know what I mean, from an auditing point of view, but that's a control that's in place for your audit.
We do cash sheets every morning. We email down cash sheets once a week, every Monday morning. We do cash sheets for each day. You have all your credit cards, your different tills, you have credit card machines, tills, vouchers, credit notes, returns, refunds, all that kind of stuff. All goes on the cash sheet.
So you've control in place for that. We never thought of probably an auditing thing before, that you actually have a control in place.
That's the whole reason.
Yeah, the whole reason it's there.
They're double checking me.
But yeah, and then you probably have someone coming on after and checking them then again. Yeah. Okay, so is that alright? 2 different types of controls, okay? Preventive controls and detection controls. And we're going through all these now. We're going through sales, purchases, inventory, wages. We're going through all them as over the next couple of weeks. And different controls, that's me sitting on that, I think. The different controls that should be there. Okay? So if you look at the next page there, what do controls achieve? Okay, so the aim of control is to achieve a specific objective. Okay, so there's 4 parts to this. Part A, achieve a specific objective. B, meet the standards. C, compare results with standards. And D, correct discrepancies. Okay, so you have 4 things there the controls should achieve. Okay, so our first one, achieve specific objectives. Each function or system is attempting to achieve some specified objective. The controls must work so that these objectives are met. For example, one objective of the cash function might be that all cash receipts are accounted for properly and on a timely basis. Another objective might be to prevent or detect within a short period of time the interception of unrecorded cash receipts or the misappropriation of recorded cash receipts. We can summarise the primary objective of internal controls as ensure the reliability and integrity of information, ensure compliance with policies, plans, procedures, law and regulations, ensuring the safeguarding of assets, ensure the efficient and economical use of resources, ensure the accomplishment of established objectives and goals for operational activities. And the majority of controls will satisfy one or more of these primary objectives. Okay, so they're each to achieve a specific objective. Number B is to meet standards. Not only each function or system have objectives to be achieved, but standards have to be met in fulfilling these objectives. Performance standards need to be set so that the actual performance can be measured against these. For example, a standard for a timely basis might be set within 1 day of receipt. Compare results with standards. Controls should be built into the system to compare results with standards to highlight significant variances. Detection controls are also used to carry out comparisons with standards. And then correct discrepancies. Controls will ensure discrepancies are investigated and the causes are corrected. All those above elements of control are needed to ensure that a system or function operates adequately. Then the framework of the control. The following is a framework of common controls. Organizational controls, okay, that's number A. B, policy controls. C, procedural controls. and we have E, accounting, budget, reporting, internal review. Okay, so we're looking at all the different types of controls and what each of them actually could do. Okay, so organisational controls. This involves assigning roles to people within the organisation so as to facilitate the attainment of objectives. There are several different aspects of this means of control. So define roles and duties. Each person should be aware of the extent and scope of the duties assigned to him and the reporting lines which have to be established. So you have to stay inside your little box and don't jump out into the next little box. Responsibilities. Responsibility should be divided so that no one person will control all phases of any transaction. Each manager should have his individual responsibility clearly defined, and he should have the authority to take the action necessary to discharge that responsibility. Okay, so you define roles, then what is that manager's responsibility? Then organisation charts. Simple charts and manuals should exist to show structures, reporting lines and duties should be issued to employees to ensure an adequate understanding of their roles and duties. Delegation of authority. Proper delegation procedures should be established where authority delegates to Subordinates, yeah. There should be followed up by superiors and reported by subordinates on the manner in which responsibilities have been discharged. So all you do is like say you've got the top guy, the middle guy and the bottom guy, and each of their duties are actually segregated off and each one knows what each of their duties is. Okay, and usually the bottom guy is the person reporting back to the top guy and he's the final say, and they all have different duties to actually perform within the organisation. So like you think of like the wages, like you have someone who actually put in the hours, okay, someone who might actually just confirm that these hours are okay, and you have maybe the top guy just doing the check side of it, which might happen, do you know what I mean? Just think of each little different little piece along the line, and you wouldn't have the same person doing the same things. Okay, thinking big companies here now again, not our small companies.
But we'd do it like our flats down hours at the end of the week.
To be, yeah.
At Mary in the office, and then she put through the hours in the system, and then they're like, okay.
Yeah, she probably someone signing. Would you have someone signing him off then maybe for her?
Oh, the boss.
The boss, yeah.
She's assisting, so she
Yeah.
know things.
And he'd sign him off then after that. Yeah, so that's just segregating out the duties in as well. So the biggest thing for this is actually to apply, you know, from a business you've been in or stuff, just apply that to these different controls and look at different controls you're actually using. It makes auditing a bit easier, then, do you know what I mean? We can apply a real life scenario to them. Policy controls. The organisation must establish policies to guide and restrict actions within it. These could be classed, okay, sorry, I just missed the end of it there. These could be classed as the set of rules laid down by the organisation. Aspect of controls through policies are formalisations. Policies must be stated clearly in writing, usually in handbooks and manuals, and communicated to all the employees. The nature. Policies must comply with legislation and external regulations, be consistent with objectives set for the organisation, and they should be reviewed and revised periodically. Okay, so like think of like a food production unit. Like you need to set down in writing in handbooks and manuals and communicate to all the employees. Think of like using HACCP, and all the controls must be in place, you know, for the use of HACCP, the hazard analysis critical control point, and, you know, for doing your cleaning, and all the employees know that and how they actually should work it. Do you know what I mean? Just think about like that, what you should actually do. And just like in the supermarket, you can see them all up in the butcher's places and all that.
CCP1 and all that.
Yeah, CCP1, critical control point here, critical control point here. And like, you could like, what else would they actually use? They have manual handling courses, all that kind of stuff that's communicated out to the different employees. Procedural controls. These are the details, method devised to carry out activities so as to conform with prescribed policies. Okay, the word there at the end is policies. Okay, many exam questions focus entirely on procedures. We should remember that this is only part of the overall framework of control. Okay, we'll come back to that because that's going to become a lot of questions. Number one, the aspect of control through procedures are: 1. Division of duties. This is a main aspect of internal check. Separation of duties between persons and departments, so that no one person or department is responsible for carrying out a complete transaction. In particular, functions should be separated into those that involve recording of transactions. Okay, that's recording of transactions at the end there. And that those involve physical custody of assets. Separation of duties allows one person, allows one is at the end there, to check the work of another and reduces the risk of error and other irregularities. Physical controls, responsibilities for physical control of assets will be allocated to certain personnel. In addition, procedures will be set up to ensure their safe custody, locking of buildings, control of keys. Okay, physical controls. So division of duties, physical controls, authorization and approval. Authorization limits must be delegated by senior management to named persons who should be aware of the scope and limit of the delegated authority to authorize payments, etc. So you've got division of duties, physical controls, and authorization and approval. And it's really about separating out all the little bits and pieces. And division of duties, the one person starts the transaction, another person has another part of it, and a third person actually has the final say at the end of it. Personnel controls. Personnel are a vital resource, and it's important that proper control is exercised to ensure selection of appropriate personnel according to experience and qualifications, development of personnel by means of training courses, and then adequate supervision is provided and the performance of personnel is reviewed periodically. Accounting is a vital means of financial control over activities and resources. These controls exist within the recording function and include control accounts, reconciliation statements, trial balances. Okay? And that's all we do inside the accounting. All these, we don't think of them as controls, just think of reconciling our bank, reconciling our wage, reconciling our VAT, but they're all inbuilt controls within the system to produce a final set of accounts. Managers should be provided with the information they need to make rational decisions on financial matters. Budgets are statements of expected results expressed in numerical terms, i.e. money, units of production, as a control to set a standard against which performance can be measured. And what normally happens in bigger organisations, they have their budgets and then they actually would have what really happened, okay, and they're actually comparing your budgets with your actual to see, do you know what I mean, why was there such a big or small difference inside there. Reporting. Every organisation needs a good internal reporting system to ensure that information available upon which decisions can be based. Performance reports should be timely and should show comparisons with predetermined standards. And then internal review. People who are independent of those operations should periodically review all operations. Internal audit is one means of this control. Okay, and the internal audit goes back and looks over everything. Now that's a lot of reading there. Okay, but even for tonight, you can just get the two different types, preventative and detection, and how you would apply preventative and how you would apply detection. And the more exam questions we do then, that these procedures and stuff will actually become hopefully easier to think of as we go through them. Okay, then there's of course the downside of internal controls, the limitations of internal controls. Although sound systems internal control can in theory be established, in practice there may be limitation on their effectiveness. And this actually comes up as an exam question too. Okay, what are the limitations of internal controls? And in the second part, controls in a computerized system. Small enterprise, and this is the biggest one, small enterprises often do not have sufficient staff to allow complete division of duties. For example, at holiday periods, one member of staff may take the role of another and effectively combine the recording of transactions and physical custody of assets. That happens a lot in small businesses, there isn't enough staff there. Fraudulent collusion between persons forming part of the system of internal controls could defeat the established controls. The person having authority could misuse authorization controls. Managers sometimes choose to ignore the control system it has agreed to set up if it suits its particular purpose. And sometimes the perceived cost of the control may outweigh the perceived benefit of the control. Okay, and that's the biggest factor really, isn't it? Cost. And then controls in a computerized system. So far we've looked at controls in manual systems, however the same principles also apply to a computerized system. Internal controls are essential in computerized systems, and the control objectives are similar to those for manual systems. The actual nature of the controls may differ, but the objective remain the same. Some of the differences in means used to achieve control in a computer environment are: certain controls may be built into the software used. Access to the machines themselves may be established, and that's just simply having a password and everyone having a different password, so you can actually see who's actually logged in there and who did what inside in the system. Much control is exercised within the specialised data processing department, and audit trails must be established so the transaction can be traced from their initiation through intermediate steps to final reporting. Okay, and that's a good one to remember. Audit trails must be established. That's a big part of our auditing. You must have a trail. You must be able to start. So that if you go into a business, okay, you must be able to take one transaction and you should be able to verify it the whole way through, from when, say, the goods have actually arrived inside in the warehouse to actually when they were sold. You must have an audit trail there to actually be able to see that whole transaction taking place. And that's good work to put in when you're actually doing auditing, your audit trails. Transaction processing within the computer is not visible in the same way the manual processing is. Okay, so just to know that you do need internal controls in a computerized system and how they may differ from the other controls.
Everybody in revenue, they all have their passwords and stuff, and
they all have their own passwords, had they?
But it was burnt into them that even if they have to go to the toilet, log off your
log off your computer, so that no one could actually go in
and sit down next to you, could sit into your computer and do something. Look up their own stuff or something.
And it could be you, or that would log on, it was you did it, and it was you hadn't done it at all.
Because people let go, they were transferring people's refunds into their own accounts.
Alright. So that's the control there, like, for that thing. Yeah. And that's like an easy one to remember, just actually having control over the passwords and everyone having their own password and their own username inside there. Okay, so that's our materiality, our internal controls, and our third aspect is audit risk. And inside audit risk we have 3 different things to actually look at. And actually we have notes on this as well in summarised form. So audit risk and audit evidence. This one here. Yeah, audit risk and audit evidence. Just bring this up here. And this now comes up, when we do a question tonight in it comes up as a purely theory question. This audit risk, and it asks you what is audit risk. So I'll be going through that there at the end. How's that look on the, is it very dark?
No, it's better.
Is it, yeah? Great. Okay, so I'm going to read from this one first, okay, and then go through the summarised version as well. Okay, so audit risk. What is audit risk? The concept of audit risk means that there is an element of risk during every audit, that the auditor will give an opinion which is wrong in some respect. Okay, so that's what audit risk is, and just to know the definition for it. Okay, it means that there is an element of risk during every audit, that the auditor will give an opinion which is wrong in some respect. The concept of audit risk is closely linked to materiality. Okay, so we're kind of linking them up together here now. Okay, so AR, audit risk, is the risk that auditors may give an inappropriate audit opinion on the financial statements. They may give an opinion that the financial statements give a true and fair view when this is not the case, or vice versa. Okay, so remember what our audit is. When we do an audit, we're not looking for mistakes and fraud and all this. We're actually looking to give an opinion that the financial statement at the end of the year give a true and fair view. That's what the auditor's main duty is. Okay, sorry, the words are not coming tonight. I think it's just from, I was saying last night, the day, it's just mad day. Okay, so audit risk has three main components. So we've got audit risk, okay, then we've got inherent risk, number A, number B is control risk, and number C is detection risk. And all these are all interlinked together. Okay, so inherent risk. Inherent risk is the susceptibility of an account balance or class of transaction to material misstatement. This applies either individually or when aggregated with misstatements in other balances or classes of transactions, respective of related internal controls. Factors that contribute to inherent risk include lack of integrity of management, nature of the client's high-tech industries, complexity of transactions, and susceptibility of assets to loss. Okay, so your inherent risk is inside there, right? And it's where your accounts are susceptible to misstatement. Okay, and the cash is a big one there. Okay, cash is not going through the proper way, so you haven't got the proper control over your cash. There isn't a secret number on all your invoices. There's not all your till roads are not being checked and put through. There's cash actually being lost through the system. That's a risk that the auditor has to face that might be happening inside the audit. Control risk is the risk that a misstatement in account balance or class of transactions, either individually or in aggregate, would not be prevented or detected and corrected on a timely basis by the client's accounting and internal control system. Okay, and it's important, it's the client's accounting and internal control systems. Factors that contribute to control risk include the control environment, so any lack of awareness directed regarding internal controls, the extent of segregation of duties, and the extent of compensating controls. Okay, so you've got your audit risk on top, inherent risk, control risk, and then detection risk. Detection risk is the risk that the auditors, okay, detection risk applies to your auditor, substantive procedures do not detect a material misstatement in an account balance or class of transaction, and this applies individually or when aggregated. Okay? So the inherent risk is your account balance or class of transactions are open to material misstatement. Your control risk is that the client's accounting internal control system is not working properly, and the detection risk is for your auditor may not actually find a material misstatement inside the accounts. Okay, is that alright? Yeah? I know it just takes a while and after a while this will become clearer as we do the exam questions. So you've got your audit risk, and under that you've got your inherent risk, control risk, and you've got detection risk. Your inherent risk goes back to your transactions, your control risk, your controls that are in place, and then your detection risk that the auditor may not find a misstatement inside the audit. Okay, so for calculations, during an audit, the partner in charge usually lists the overall acceptable audit risk for a particular system. The inherent risk within the system is determined by considering the nature of the business and the transactions. The control risk will be assessed and confirmed using compliance tests, test controls, and the control risk will be high where internal controls are weak. Okay, so you're linking your control risk with your internal controls. So if the company has a set of controls, okay, and they're actually weak, okay, so they're not proper controls in place, then that makes the job of the auditor harder because he actually has to do more testing and looking for information to confirm his opinion that the account gives a true and fair view. Detection risk then is a risk that can be permitted in testing and still achieve the overall of a set level of audit risk. So accounting risk equals detection risk by inherent risk by control risk. So if your audit risk is set at 5%, inherent risk is 90 and control is 30, detection risk is calculated as 0.05 multiplied by detection risk by 90% by 30% So just do a little formula. And I don't think you'd be actually asked to do that, but just to know they're actually all interlinked, that your auditing risk equals your detection by your inherent by your control risk. A low detection risk will require a large number of transactions to be tested using substantive procedures. This is because only a low level detection risk can be permitted if the overall level of audit risk is to be achieved. Conversely, a high detection risk means that only a small number of transactions need to be tested. So audit work risk. In addition to risks inherent in the activity of the client, there is also a risk that the audit staff will not conduct a perfect audit in all particulars. This can include the failure to detect a system weakness or fraudulent activities. So examples of work failure are failure to carry out a necessary test, failure to gather enough evidence in a high-risk area, acceptance of inadequate explanations, failure to draw the correct inferences from audit evidence and analytical review procedures, use of the wrong audit procedures, and sampling risk. Nearly all audit tests by sampling, and the use of sampling inevitably involves the risk of non-discovery of some relevant item or the acceptance of internal controls which not operate on some relevant occasion. So think about if you're doing a big audit now, right, and they have like 1 million transactions. You take a sample. You can't just like go through 1 million transactions and actually look and see are they all correct. You're just taking out a little sample of them all. Whereas you've got a small company who have got maybe 50 transactions during a year. Okay, they only issue 1 invoice a week. Then you've no problem because you can actually go through them and actually do the whole 50. Okay? So I know that's tough going, okay? The risk side of it. But I said, like, as we do the questions, it'll become easier to understand. Just to know that your audit risk, your inherent risk, your control risk, your detection risk, they're all interlinked together. And then your risk goes back to your internal controls, okay? Because if the business hasn't got good internal controls, it means your audit risk is going to be higher. Okay, and your risk is where you won't actually find something that's wrong inside there. And then your materiality, go back to the start, where you've set a percentage of materiality that can be out by, and if all these are weak, then your materiality, you have to do more and more testing, okay, which means more and more cost to the client. Error, yeah. Okay, so if you just go over to the little handout notes here. Okay, so audit risk, the possibility that the auditors may unknowingly fail to appropriately modify their opinion on financial statements that are materially misstated. This directs that the auditors will issue an unqualified opinion on financial statements that contain a material departure from GAAP. Auditors must obtain sufficient appropriate audit evidence, and that's a good line. Auditors must obtain sufficient appropriate audit evidence to reduce audit risk to a low level in every audit. Okay, and we've got our financial statement assertions. Do you remember we did our auditing assertions last week? Do you remember doing them? Yeah? Okay, and the good one with these, if you take your assertion, what the implication is and give an example of it as well. And we're going through more and more of these now as well during the exam papers. Okay, so I'm not going to go through all that again. So if you skip on to page 3. Okay, so this is our audit risk example again. Okay, so your audit risk is your inherent risk by your control risk by your detection risk. So your inherent risk is a risk of a material misstatement occurring in an assertion assuming no related internal controls. Control risk that a material misstatement in an assertion will not be prevented or detected on a timely basis by the company's internal controls. And then detection risk that the audit procedures will not lead them to conclude that a material misstatement does not exist in an assertion when in fact such a misstatement does exist. And it's probably a good little slide there that has all the 3 types of risk and linking back to your audit risk as well. So you've got the same thing here now, your audit risk formula, inherent risk by control risk by detection risk. Okay, there you are. You 3 of them. Okay, and just gives a little figure there are the risk of material misstatement. Your detection risk, the risk that auditors will fail to detect material misstatement. And they're showing like that they're all linking to each other. So where the sand is flowing down, so they're all actually linking in to each other down around the little what's that called, the little sieve thing. Okay, so you see the inheritance risk. The misstatement is likely to occur in the client's financial statements. The control risk, the misstatement prevented or detected by controls. Misstatement that bypass the client's control within. Misstatement detected by the auditor's procedures, which is their detection risk. And your audit risk, misstatement undetected by the auditors. Okay, so it's actually like a little chart, and they're all interlinking between each other. Okay, so we go on to the next page there, page 5. Okay, and that's our inherent risk. Factors that affect inherent risk: the nature of the client and its environment, the nature of the particular financial statement element. So business characteristics indicative of high inherent risk. Inconsistent profitability of a client. Operating results highly sensitive to economic factors. Going concerns problems. Large known and likely misstatements detected in prior audits. And substantial turnover. Questionable reputation or inadequate accounting skills of management. So all those factors affect your inherent risk. So if you had a question coming up, what is inherent risk? Give it a little definition, and then you could mention these, that all these items affect your inherent risk. Okay? And if you look at your inherent risk, your inherent risk is misstatements are likely to occur in the client's financial statements. So if you've got a management who's not good on the accounting side of things, but great at doing his own business, I mean, great at bringing in clients, great at selling stuff, could sell ice to an Eskimo, but is not good on the accounting side, then there could be, it's a risk inside there that he's done something wrong inside his accounting items. Going concern problems, okay, where things are going, and it's like a big thing at the moment, and well, maybe now things are starting to turn around, but the last couple of years, like if you were doing an audit of a builder or something, like going concern was a big thing, that would they be able to continue in business for the next year. Then assertions with high inherent risk involve difficulty to audit transactions or balances, complex calculations, difficult accounting issues, significant judgment by management, and valuation that vary significantly based on economic factors. And that's a big thing as well, valuation. Like if you look at the price of land if you're doing a builder or price of a house back in 2007 compared to now, there's big differences in the valuations, isn't there? Even cars and stuff, so the value of cars have plummeted down as well, like, haven't they?
Yeah.
So in types of transactions, routine, recurring financial statement activities, recorded accounting records in the normal course of business. Not lower inherent risk. Non-routine involve activities that occur only periodically, such as the taking of physical inventories. There's a high inherent risk there. And then estimation transactions, activities that create accounting estimates have higher inherent risk. So something that's happening all the time, so you've got a recurring thing happening in financial statements all the time, that's going to be low risk of, okay, go back again, a misstatement likely to occur in the client's financial statements. If it's routine, low incurrent, non-routine, high inherent, and then estimations, high, because estimations are always going to be a high. Okay, then the third field work standard. Third standard of field work. The auditor must obtain sufficient appropriate audit evidence by performing audit procedures to perform a reasonable basis of an opinion regarding financial statements under audit. Sufficient audit evidence, the quality of audit evidence that must be obtained. Okay, and audit evidence is the biggest part of our audit here now. Okay, so I think you have audit evidence here. So the appropriateness of audit evidence. To be appropriate, audit evidence must be relevant and reliable. Audit evidence is ordinarily more reliable when it is obtained from knowledgeable, independent sources outside the company rather than non-independent sources. Generated internally through a system of effective controls rather than ineffective controls. obtained directly by the auditor rather than indirectly or by inference, documentary in form rather than oral, and provided by original documents rather than copies. So what we're doing here now is audit evidence, okay? So we're finding audit evidence. So if we were doing the audit, okay, of our bank, okay? We've got a balance in our bank, we can match it with our bank statement, okay, we want that confirmed, send off your authority to the bank, they confirm it for you and come back to you. So you've got outside audit evidence proving that that balance on the bank is right. The same with your debtors, you take a sample of your debtors, send off a circular to your debtors, and they come back and confirm that this figure is right and it's matching with them. So that's your audit evidence, and it is obtained from outside, independent, rather than just being told to you by the client. Okay, and that they always say third-party audit evidence is better if you can actually get it. Then reliability of certain types of audit evidence. Okay, so physical inventory observation. So if you're doing the audit of a big client who's got big warehouses, you actually send, if you're coming from one of the big four now, you actually go out and send a team out when the inventory count is being done, and you watch them how they actually do that inventory count. A small business practice now wouldn't be able to do that, but don't take like a KPMG, Ernst & Young, all them, they'd actually go out, they'd have a set team who's doing that audit, and they'd actually go out and actually watch the audit being done, sorry, not the audit, the inventory check being done there at the time. And documentary, external, cut-off bank statement, external again, purchase invoices, internal, sales invoices. Then client representation, management representation letter. Okay, so that's the management are actually telling you information which isn't as good as actually having outside information or actually going and seeing the inventory count being done yourself. And we're actually going through the management representation letters, we'll be going through them and having samples of them as well. Okay, so this is our audit evidence. Okay, so types of audit evidence. Okay, so types of audit evidence, that's our reliability. So then we've got types. So accounting information systems, the accounting records and support for transactions and journal entries, documentary evidence, checks, invoices, contracts, minutes of meetings. And a big one inside the bigger clients is the minutes of meetings. You'd see what was discussed inside the board meeting if you're having a board meeting every month. I mean, you make sure you get those minutes of the meetings. Third-party representations, confirmation, lawyers' letters, specialist reports. And what you send for the solicitor and the lawyer, you get a confirmation from the company solicitor that there's no litigation taking place against the company. There's actually no claim in against them at a particular point, which could impact on your opinion. Okay? And physical evidence, examination of an asset. Okay, it should actually go out to the client and actually look at, you have their assets in their balance sheet. You go out there and you actually ask them to physically see those assets. Computations, footing and recalculations. So like do your wages, you'd actually go pick a week in the year and you go back and actually recalculate them to make sure that they've actually calculated them properly. Data interrelationships, analytical procedures, okay, and just if you want to mark analytical procedures, we're going through analytical procedures again later on. And then client representation, a representation letter. Okay, and that comes up as a question too. Okay, so you've got your audit evidence, okay, and you need, just remember that line there, sufficient appropriate audit evidence. That's what we're actually looking for. Okay, if you want to highlight that part, sufficient appropriate audit evidence, and you're going to be performing audit procedures. It's page 6, the one there. Must obtain sufficient appropriate audit evidence. Okay, and if you can remember that little box here, and it comes up like what type of audit evidence. If you can remember the little box there, and what the type, and give an example, that shows you know what type of audit evidence you should actually be looking for. Okay, so our next one is overall types of audit procedures. Okay, so we're looking for audit evidence. So risk assessment procedures. To obtain understanding of the client and its environment, including its internal control, to assess the risk of material misstatement. So you sit down, okay, and if you've known the client for years, okay, you know how their account works, how the system works. We've got someone new coming into you, see what kind of business they're in, see, look at their sales, look at all this stuff, and see what they actually are doing and how they control their stuff, what they actually do in the business. Okay, when you're actually sitting down to look at the system at the client first day, okay, you must make an opinion about them. You must look at them, and you've got a risk assessment procedure. You must get the understanding of the client and its environment, including its internal controls. Then further audit procedures, test the controls, when appropriate to test the operating effectiveness of controls and preventing material misstatements, and then substantive procedures. To detect material misstatements at a relevant assertion level, substantive procedures include analytical procedures, test details of account balances, transactions, and disclosures. And if you go over to the next page here, we've got analytical procedures. So test the details. We test the account balances, test the class of transactions, test of the closures. One may change the scope of the audit procedures by changing the nature, timing, and the extent. Okay? The type and form, when performed, the quality of the evidence obtained. That's good here, the quality of the evidence obtained. If the evidence you've obtained about a certain item is not good evidence, you might have to actually go away and actually get more evidence on it. Then the nature and timing of procedures. Holding the extent of procedures constant, one may increase the scope of procedures, making them more effective by either changing nature, timing, waiting until the year end to obtain evidence from entire set of transactions as contracts to performing interim testing, say 2 months prior to a year end, and simply updating those procedures. And normally at the year end, do you know what I mean, you'd actually do your timing, you'd wait and get you all your evidence then. Hold other factors such as the nature and timing of procedures constant. The greater the risk of material misstatement, the greater the risk of material misstatement, the greater the need extent of substantive procedures. Okay, so the more material, okay, we think our misstatement is going to be, the more procedures we're going to have to do. The main way to increase the extent of our procedures is to examine more items. Okay, that's basically in English what it is. Okay, the more procedures you need to do, the more testing and the more items you actually need to look at. Sample sizes should reduce detection risk so as to restrict audit risk to a low level. Analytical procedures, the steps involved, develop expectation of account or ratio balance, determine the amount of difference that can be accepted without investigation, compare the company's ratio with the expectation, investigate and evaluate significant differences. Okay, that's heavy going stuff. Okay, just move on there for the moment. Okay, if we skip on to basic approaches to auditing accounting estimates. Okay, I will come back to this, or else you'll all be yeah. If you look at the top one there first, identifying potential misstatements. Okay, so our analytical procedure, comparison of inventory levels for the current years to those from prior years. The potential misstatements is misstatement of inventory obsolescence problem, comparison of research and development expense to the budgeted amount, misclassification of research and development expenses, comparison of accounts receivable turnover for the current year to the prior year, misstatement of sales or accounts receivable, misstatement of the allowance for uncollectible accounts, comparison of the client's gross profit percentage to published industry averages, misstatement of sales and accounts receivable, misstatement of cost of goods sold and inventory. So, do you know what I mean? You have for shops, there'll be a certain average that should be kept, or for all business, you have an average that should be kept. And if your average is totally off of what the the average is, that doesn't sound right, it does. The average is for that business, then there's something wrong. Okay, like if your inventory has been is not correct, then that's going to affect your margin figure. If your cash sales haven't actually been included in your sales, that's going to affect your average. And that's a big thing doing, no matter if you're having an audit, if you're just preparing a set of accounts, you have to watch your margin all the times. And like, you know, from the revenue, they have a system where they have the average for all the businesses, and they compare it, when your accounts go in, they compare it to make sure your average is somewhere in line with the rest of the businesses around you. Like for a pub, let's say your margin should be 55%. For shops, you're looking for 20 to 30%. So and they'll be watching that all the time, and like it's got little red flags then if your margins are, like if a shop, let's say now in Mallow, and you've got a shop has a margin of 20%, and the shop then down the road has only a margin of 8, that's going to be setting off a little flag inside there for them. And the same thing if you are doing an audit for a company, and your average, you're doing the audit for the last 5 years, and your average has always been 50%, and all of a sudden your margin is down to 20%, where there's something gone wrong inside there. There's something wrong in either the stock, okay, because the stock affects your gross profit, or it's something wrong with your sales, or that your purchases have been overstated. Okay, just think about it like that. Comparison of production records in units to sales, misstatement of sales, misstatement of inventory. Comparison of interest expense to the average outstanding balance of interest-bearing debt. Understatement of liabilities, misstatement of the interest expense. Okay, and you go back to the bank and actually get that, couldn't you? If there's an interest expense for a bank, okay, go back to your bank and actually get all the evidence that actually is the correct balance. It's all about confirming your figures, okay, getting enough audit evidence to prove that those figures are okay. Okay, then the basic approach to auditing and counting estimates. Review and test the manager's process for developing the estimate. Independently develop an estimate to compare it to management's estimate, and review subsequent events or transactions bearing on that estimate. So the management have come up with an estimate on something for the end of the year. Okay, you actually have to come up with another ratio that will actually compare it to make sure that's right. Okay, because they're only estimates, it's actually very hard to audit estimates, because that's what they are. They're estimates. They're not actual figures, they're only estimates. Auditing fair value. Inputs to use in applying valuation techniques. So level 1, inputs of observable quoted prices in active markets. Okay, I'm not going to go through all this tonight. Okay, move on with that. We're going to do an exam question to actually make that actually easier. Okay, related party transactions. Disclosure items must be met. Primary challenge is identifying undisclosed related party transactions. Determine related parties, inquiries of management. Review SEC filings, stockholders listings and conflict of interest statements. Be alert for transactions with related parties and any transaction with unusual terms. So a class example of related parties, you've got the director, right? And he owns the building that the premises is operating inside. So inside your audit at the end, you'd have to put down related party transactions as a heading, and that the director, whatever his name is renting the building to the business. Okay? Or you could have, for your bank, you have a director has given a personal guarantee to the bank about a loan. That's another related party transaction. But the probably easy one to remember is that you've got the director owning the building, okay, separately to the company, and he's renting the business property to the business.
That's
so
allowed, is it?
It's allowed, yeah, it's allowed. You just have to actually say it on your audit that there's a related party transaction inside there. Okay.
You don't go into the thing where that has to be agreed by all the directors and all.
Well, that'd be a big one now. Before you got 2 directors in there, who usually husband and wife, then there's no problem. But if it's a big company, then you have to do see about the rent. Is the rent, do you know what I mean? Is he's not being overpaid the rent? Is it market value rent? Do you know what I mean? He's not being paid a huge amount him up more just because he's the director and it's his building.
Yeah, the business management thing then wasn't there, or is it the law? I can't remember. Wasn't there something where all the directors have to agree? There's things you have to.
They'd have to agree, yeah. That it's okay for him as owner of the building to rent it to the. That doesn't come into this, no, not at the moment anyway, no. Okay. Okay, so I'll just finish with this at the moment and then I'll go on to something a little bit more interesting. Okay, so function of audit documentation. The primary functions: support the auditor's compliance with auditing standards, support the auditor's opinion. The secondary function is assist continuing and new audit team members in planning and performing the audit, serves the record of matters of continuing audit interest, assist in supervision and review of the audit, demonstrates the accountability of team members, assist internal reviewers, external peer reviewers, PCAOB inspectors, let's check what that is, PCAOB inspectors, and successor auditors in performing their roles. So it's like, what are the two functions of audit documentation? So you've got the primary function is to actually support the auditor's opinion, and then the second one is that when if you've done the audit for that year, coming on to the second year, you have a new team of people doing the audit, that they can follow all documentation from the last year. It's very easy for them to continue on into the next year's one. Sufficiency of audit documentation. Audit documentation should be sufficient to enable an experienced auditor to understand the work performed and significant conclusions reached. So you're an auditor, right, and you're a total stranger to the business. You should be able to go in, sit down, pick up your audit plan, and you should actually be able to see exactly what was done, when it was done, who did it, and that all the objectives actually met, even if you had no knowledge of that particular business. Okay, so it should be very clear for everyone to actually see.
So when you do an audit, you leave that behind you so that the next
person
can come along.
The next person can come along, or if someone, say like you have a monitoring visit from your institute, they come out and they can actually sit down, they don't know the client, but they can actually get knowledge of the client from your planning memorandum. They can get all the information from that the correct audit opinion was actually given. And you can actually hold it either on a paper one, or now you can actually hold it on computerized version now as well. They accept either or. Identify who performed and reviewed the work. So you've got an audit paper, you've got a working paper, okay? So say I prepared one part of it, so I did the test, okay, and this is my conclusion, and I've done CMC this, and then my boss had come along and he reviewed it and he put his initials and the date after it. So you always have two people signing off. You've got the person who actually performed the test and the person who actually reviewed it. Show that the accounting agree or reconcile to the financial statements. All documentation should include all significant audit findings and the actions taken to address them. Okay, then types of working paper. Audit administration working papers, working trial balance, lead schedule, adjusting journal entries and reclassification of entries, supporting schedules, analysis of a ledger account, reconciliations, computational working papers, corroborating documents. So then types of working files, you've got a current file. The current file has a current year's working papers, indexed and cross-referenced. And you've got permanent files, and then items of continuing audit interest. So like you have an audit for December 13 and you have all the information relating to 2013 inside that current file. You have a permanent file then which have the copy. We all know have to have a copy of the driving license or passport of the directors. So that would be inside there in the permanent file. That would be continuing on every year. You'd have your audit engagement letter inside there. Maybe if they owned a building, you'd have the title deeds inside there. If they had a machine, you'd have the deeds inside there too. If there was a lease, maybe for 5 or 10 years, you'd have a copy of that lease inside there, so if you needed it, inside your permanent file, you can actually get it straight away. Whereas your current files would have all your accounts, all the audit evidence you collected, all your working paper inside there. Okay, whereas your permanent file would be separate to that. It would be a separate folder of stuff you'd actually have on that client. Okay, and see the next page there. I know it's very tiny. Okay, if you look, see the bottom one there, preparation of a working paper. See down the bottom, there's actually a little place. I don't know if I can make that bigger. That can be made bigger. Oh, there we go.
Can we get that printed in the bigger one?
Yeah, what I'll do, I'll get it printed out. That's better now, isn't it? Okay, so you see, we're doing the audit of Main Company Inc. Okay, and you see here, index number C5, prepared initials and date, so whoever prepared it and the date. Tick and mark, so you have a little ticking scheme. I usually do an X and a cross and a little circle inside it that I've actually ticked it and it's actually balanced off with something. Adjusted entry, cross-reference to adjusting entries, working paper. So when you did your entry here, there was something wrong, and you actually had to go back to a working paper and actually redo it out again. Explanation of audit work performed. Examine the controller's authorization for write-off. Agree to general ledger. See the little ticking system you have here in place then. And then the auditor's conclusion. Based on the results of the test of collectability and analytical procedures on C6, the adjusted balance of the allowance for uncollectible accounts appears to be adequate to validate the account receivable at net realizable value. Okay, and then it's the name here, prepared initials and date, and they actually have their name, their initials down here, and then this is probably whoever reviewed it after has put their initials here as well. Okay, and you always have to see your heading on top, who you're doing, what year you're doing, and you're ticking it off. Oh yeah, see the reviewers one there. Reviewers, initials and date in here, prepared by initials and dates inside here. Tick and mark symbols, so they're using little ends, whereas I'd always use, see this is the one here, I tick them, and then I put a little roundy circle in them as well to make sure that they actually have been done. Allowance for uncollectible accounts. That's your allowance for receivables or your bad debts.
So you take them as you're doing them, and you go back over them and
put a little circle around them.
I worked out when I do the same as I worked out for the end of the month. I take them on instead or the spreadsheets and then put it across to them like that at the stage.
Yeah.
So I know myself that
they're done. So that's your control over that then you see as well. That you're doing it, yeah. And just go back to the other one there, or what they put in this one. Okay, so this is your financial statements from the trial balance, and it's a rounded off figure. Cross-reference from lead schedule, so you've got a little code here. This is your working paper and your number here then. The working paper A, cash 96,000. Adjustment and reclassification entries. So petty cash, cash in bank, general, and that's on A1. So if you want to find out then what was this, petty cash, you go to your working paper A1. If you want to general, you go to your working paper A2, and if you want your payroll, you go to working paper A3. So they obviously have a bank account, their current account, and then they have a payroll current account as well, where they're paying the payroll out of each month. So they have a balance on that as well. Cash count sheets, confirmations and reconciliations. So they're all, see the A1 then would have your reconciliations actually behind them. A little further. Okay, so you've got your little, you see, you have A1, A2, A3 for over how many notes you actually have behind them. And they're all leading, you have an index in at the end. A is this, A1 is this, A2 is this, A3 is that, A100 is this. And they're all, so if I came in now, I had no idea, I could actually open it up, my index would be in the front, and I could go, oh, I want to check my cash. So I can see cash is A1, open up A1, there is my balances. I go to A2, we have the reconciliation for this bank, A3 we have the reconciliation for this bank behind it. So anyone could go in and actually see what they have actually done.
So that's like your summary sheet, and then all stuff behind it.
Yeah, and all the stuff is actually behind it. Yeah. And it's only getting a system then of your own. Do you know what I mean? All the institutes issue a pack, Joey. They all issue an audit pack, and you follow their referencing then. So you have it on the computer. And you can just use that referencing the whole time for whatever applies to that actual audit. If that applies in it right down, not applicable to this audit on it. But other than that, use their pack they actually give you. You don't have to come up with your own referencing. it's already pre-done for you.
So they give you a template, you just go.
Yeah, and you use it like that,
So
yeah.
it's easy.
And it depends on whether you're using a large company, a small company, or an auditing company. You've got a certain pack for each of them. It's all just about, do you know what I mean? You're doing the work. Do you know, you're doing an audit, you're doing the work. Okay, so if you're doing, like we are in a small business, okay, we do the accounts and we do the audit as well. Whereas you've got a big company, they're doing their own accounts and the audit company is coming in and actually auditing them. But like, that only happens like in, do you know what I mean, the big 4 companies and stuff. It wouldn't happen in small practices. You'd be doing all the work and doing the audit as well. So you've done the work.
So you're auditing your own work basically.
So you're auditing your own work and you actually have to go back then and actually just do the index and actually show what you did. You'd have all the bank recs done, you'd have all the wages account done, you'd have all the VAT account done and controlled and everything, but you actually have to document it. This is what you did. You send it, like the bank, you got the banker's confirmation from the bank. You just have to document you did that and on what schedule. You have to take the banker's schedule in and document that. And you've got the trade debtors and you send away your circulars and you've got the debtors back and you actually have made sure that they're right. So it's just all about it's all about being neat and tidy and documenting everything you actually do. That's what it is. It actually takes more time to document the stuff and actually do the work sometimes. You know, you could be 2 or 3 hours just filling up forms, ticking and initialising them and stuff, like when you've had the bank recs done very quickly and stuff. Yeah. Okay, so we take a break there for a couple of minutes.